Okay, welcome back. There is pre-open rates already coming up on your screens. What happened during the course when we were on the TCS management was that I think SGX Nifty futures corrected a little bit more, and I think that's on the back of two things. One, US futures themselves corrected a bit, the US rates market has opened and yields have headed higher in Asia. Those are the two things which incrementally moved a little bit in the last 40-45 minutes or so. These are very initial rates. We'll have to wait 2-3 minutes and we'll get a better picture. This should be a lower start, most likely. I mean, Asian markets, etc., are also reflecting that. Anuj is here with what he's watching out for. Anuj, hi.
Yeah, hi, Prashant. So the big question, billion-dollar question literally is why are FIs shorting so much? In index futures, there was net build-up of 15,000 shorts, which has taken the FI short build-up to record 1.1 lakh. By the way, this also means the retail book is at all-time high. And the last 3 times it's happened, the market has actually rallied 15% after that. This is a data point that I'm working on. So FIs are 18% long and 82% short on Nifty, and this is a big theme. Above 17,500, you expect big short covering, and below 16,800, perhaps big decline. So 17,064, yesterday's low, should be the first support, and 16,818, the sacrosanct support on a closing basis, and 17,400 to 500, that congestion zone, which is where the 20-day moving average is also placed. On the bank Nifty, it turned yesterday right from that crucial support mark of 38,500, which now becomes your crucial support. That's where you have the highest put open interest build up as well. So that's a level to defend. On the upside, 39,315, yesterday's high, is your first resistance, and then the 20-day moving average of 39,715 is the other important level. By the way, you're referring to Hang Seng. It's at the lowest level since 2009. Kospi in dollar terms is lowest level in 33 years, and Japanese market is yet to reclaim the 33-year high, which tells you why Indian market commands the premium it does, because in all time frames, Indian market is giving returns which most of the emerging markets are not.
Absolutely, and at a time when there's so many challenges globally, TCS saying that a double-digit growth is achievable is no mean feat, really. And that's what you're seeing in the market as well. In pre-opening, the rates are kicking in right now. The Nifty is up almost 60-odd points, and it's led by Infosys, which is up 3% on the back of the buyback proposal. ICICI Bank is the next one, up about 2-odd%. Let's take a first look at TCS and how it's shaping up. But it has reflected, the sentiment is definitely rubbing off on all the other stocks. TCS is now up 0.5%. You have all the other IT names which are looking pretty good. Mitesh Thakkar and Sudarshan Sukhani are joining in now to tell us how to approach trade this morning. Sudarshan, good morning. Looks like a good day. TCS reported decent numbers. Management commentary was not too bad. How are you approaching that space and the market in general?
Good morning. See, I don't have a view on TCS for the day. I have a view on TCS for the long-term investors who will really make money in these stocks. And whether it's TCS or Infosys, these 25-30% dips in these stocks are buying opportunities. You won't get them again. So that's the view on these two stocks. Now, for the markets in general, it does appear that 17,100 was holding yesterday. There was a buying opportunity we talked about, and that worked. I would say that the markets are willing to see if they can bounce higher. So the trade today still is to buy on a dip, and don't keep a stop very tight. Keep a 100-point stop from the opening price. I think we should see another rally today. Tomorrow will be another day, but today consider buying the Nifty and the Bank Nifty.
Okay, Mitesh, good morning. Would you concur with that view? Time to buy the Nifty and the Bank Nifty? And if yes, what are the levels to watch and what are the stocks that you're looking at?
Good morning. So while, I'm not very enthused about buying the Nifty immediately, but I think, yes, we should be in good stead given the fact that we have a lot of long positions in the IT names. Yesterday, I recommended about 4 or 5 IT names, and disclaimer, we have personal positions as well. But I think Nifty IT could outperform in the short term. So either, you could buy the Nifty IT stocks because Nifty IT itself is not very liquid, or, trade some kind of long bias on by buying call options on these IT names. So I think we'll focus on the IT names. Of course, Nifty, could possibly get some rub off from the IT names and possibly be on a positive side. But I think the momentum will clearly be on the IT stocks, and that's where you should be trading.
Okay, all right. What about stock-specific action, Mitesh? What are you looking at?
So we have buy calls on Excel Tech and Infosys and Coforge today. Disclaimer, Coforge, we have positions as well. Coforge is a buy with a stop at 3,600, first target of 3,720 here. Excel Tech is a buy with a stop at 949, targets of 990 here. And Infosys is a buy with a stop at 1450 with a target of 1495, though it might open above that. One sell call on Lal Path Lab. Keep a stop at 24.15. Look for targets of 2300.
And Sudarshan, how about you?
Well, primarily buying is the basic theme. Britannia is a buying opportunity. Some FMCG stocks are doing outstandingly well, much better than the Nifty. Keep a stop under 3717. HDFC AMC is a buy on dips opportunity. The stock has now moved sideways after a big mini bear market. There may be some upside here. Buy with a stop under 1888. Hind Petro is the only intraday short. The stock is not responding to any rallies. Keep a stop of 217 for an intraday short. And finally, Infosys is a buy. So keep a stop under 1426.
Okay, thanks a lot, gentlemen, for that. Dipan Mehta, the director at Elixir Equities, has been waiting by patiently. Dipan, thank you so much for waiting. We had that chat with the TCS management and you heard them out, I'm sure. They're not giving any visibility on demand going forward, but they're also saying that there are no client cancellations expected in the next 2 quarters. There's no differential spending from clients, and their deal win guidance, margin guidance is intact. Would that enthuse you? Because the stock has fallen quite a bit this year. Is it a time to re-enter into IT stocks like TCS?
Good morning, Sonia. Thanks for having me on your show. I would just little wait and watch at this point of time because the global environment is just getting murkier and murkier, and where all this is going to end is very difficult to say. And it's not that these stocks are really at very attractive valuations. You may have a bounce today, but I'm not convinced that next 3-4 quarters are going to be exceptionally good for TCS. So I would just like to wait and watch. At the same time, I think there are many good opportunities elsewhere in the non-IT space. Could be banking, auto, consumption-oriented stocks. So from a portfolio perspective, I think it's better to be overweight some of the domestic-oriented sectors than software companies at this point of time.
Look at the pre-open rates. This is how things are settling down into the 7th minute of the pre-open and 15 points higher. So this is, will we open actually in the green? We'll see, because in the last hour or so, yields have moved up. US futures are down a little bit more. Markets like Hang Seng are down another 4% after yesterday's 4% fall. But here, there is that outperformance which shows up. I was talking about day on day, week on week. You can probably add hour on hour, shorter time frames as well. Quite something. But I'm not very sure if that's the opening we will get. Eventually, like yesterday, you will get that impulse to buy is very strong, of course. Dipan, your point is taken on IT, so still cautious. But do you think incremental earnings downgrades may kind of halt a little bit here? Give some breathing space because of what we've heard from companies, and things may surely get worse before they get better. But will the market wait to see that happen before downgrading earnings now? Your sense?
See, I think more or less the downgrades have got priced in, and I don't expect further downgrades, at least not after what TCS has to say. And I'm sure the other large IT companies also would have similar commentary. That's not the issue. The issue is growth going forward. You want to buy companies which are growing at 15% plus consistently next 2-3 years or so. And that particular formula is not fitting into large cap IT at this point of time. Although we are very positive on select mid-cap IT companies which are focused on very specific verticals or have IP-related businesses, those are in a way a different zone and they can continue to grow at 15-20% or so. But large-cap IT, because of its base, because it is certainly affected by the demand environment, I would say that for them to grow at double-digit earnings per share for next 3-4 quarters looks a bit difficult. So that's the reason why we want to be a bit cautious and underweight, especially on large cap IT. But if you want to have allocation, the best is to go for some of the mid cap IT companies which have a slightly differentiated business model and are focused on very unique verticals.
All right, Dipan, I wanted to ask you about India Cement. So we'll just run our viewers through what's the news piece that came in overnight. Well, Nimesh had alerted us that it was likely to be a deal. And yes, that's precisely what's happening. JSW Cement, they've completed the acquisition of Springware Mining Private Limited. Remember, that's owned by India Cements. It's a subsidiary of theirs. And they have limestone block in Panna district. That's in Madhya Pradesh. For this, the total amount they'll be paying is around 477 crores. But various brokerages like Motilal, they are saying that they'll also receive an additional 127 crores, which is the principal plus the interest that was lent by India Cements to this particular subsidiary. So the total deal value works out to around 600 crores. The impact would be that the debt is around 3,100 crores. If they use all of this to reduce it, Debt comes down by around 20%. The promoter intent as well is positive. And now the street will wait by what are they doing with the Rajasthan plant that they have. That's around 1.5 million tons on. But both the brokerages, that's Motilal as well as Nuvama, both of them say that valuation-wise, well, the stock is looking fairly expensive at around 13 to around 15 times. However, bigger deleveraging from here on, that's something that the street will like. Well, Dipan, in pre-open, the stock, in fact, is opening with a cut of around 1%. So clearly the street, they wanted a higher valuation maybe for this. Some reports indicated it could be close to around 800 crores. How do you approach the stock? Valuation-wise, it trades around $85-90 per ton. That's EV per ton. And EV upon EBITDA, 13 to around 15 times. Your view?
No, we are generally negative on cement stocks at this point of time, India Cement included, and all rallies could use to lighten up positions over there. The reason being that there's going to be a disruption within the sector, and the way the capacity is going to come up, eventually there'll be pricing pressure as well. And this entire discipline which was there as far as capacity and cement pricing was concerned, that may get vitiated. So I would be a bit cautious. This quarter numbers also not going to be that great. So I would like to avoid cement. Let's just wait and watch and see how the industry actually evolves post the acquisition of ACC and Ambuja by Adani and the kind of massive expansion plans announced by all the large players in the sector.
Okay. I know you did mention that on TCS particularly, you would sort of wait and watch because you're not too enthused by the global situation. But on Infosys, I wanted your thoughts because there's the buyback proposal as well. Earnings are coming up. Ahead of the earnings, would you buy or caution even there?
I think it's always better from a long-term investor's perspective to wait and see what the management has to say and then perhaps take a more informed decision. But yes, there could be a trading rally today just before the results are announced. But generally, I think that's what it is, a trading rally. You cannot make an investment decision on the expectation that the numbers will be exceptional and there'll be a buyback announcement which may be positive. If you have a long-term view, it's better to just understand and what the company has to say and then take a decision.
Just a couple of names throwing your way, Dipan. One is Axis Bank. Generally, a lot of chatter, a lot of optimism around this one. Maybe a momentum-related move on the upside. On the downside, we saw that big move in India, the big cut on Indiabulls Housing. Recovered into close, though, down 6%. There was Varun Beverages and Lemon Tree, which sold off 5-6% as well. And any thoughts here?
Very positive on Axis Bank, and the numbers will support our positive view on the stock and the banking sector as a whole. Indiabulls Housing is certainly an avoid. We'd like to be in the stronger banks and NBFCs. The smaller ones, they are very susceptible to a lot of risk factors when the sector entirely goes into a bit of a tailspin, as we saw during the ILFS crisis. Very positive on Varun Beverages, I think, entering into a new growth phase, and the capacities and the acquisition which they have done over the past 2-3 years will start to play out very well in terms of higher growth rates. And I forgot the last company that you asked on was?
Lemon Tree.
The hotel company, Lemon Tree, Dipan.
Yeah, I'd rather buy Indian hotels at this point of time than Lemon Tree. But nonetheless, I think prospects of both companies and the hotel industry as a whole is pretty interesting. And certainly next 2-3 years, you could see these stocks come back into reckoning and find their way into many portfolios.
All right, fair enough. This is going to be quite interesting if we get this kind of open, 15 points higher and about 15 points on the Nifty. And actually, the positive start essentially is what is going to be an interesting one. Dipan, the IDFC twins, again, the IDFC Limited is at about 72. IDFC First, of course, is making its own move. Is there upside here?
Yes, I think usual disclosure, we and our clients are invested. We are very positive on IDFC First, and after the large cap private sector banks, IDFC First would be the top pick as far as mid cap banks are concerned. I think they've handled the entire COVID and also the integration with IDFC really well. And the way they have grown the credit book as well as the CASA book, I think is very impressive. Strong dynamic management, very strong technology platform as well, and best-in-class growth rates, reasonable valuation. So I would put I would like to look at IDFC First in a very positive light. Again, the disclosure that because we are invested, our views may be slightly prejudiced.
Okay, that is bang on time. Thanks a lot, Dipan Mehta, for joining in. Have a good one. That's the Nifty opening, absolutely flat. So as we told you, it's on one hand, you have, of course, good numbers from TCS. On the other hand, you have weak global cues. So net-net, it's absolutely quiet. By the way, TCS is actually down about 0.6%. So the first take on TCS is in the red. Perhaps Street a bit cautious because the management did say that they're not well placed to comment on the macro situation. There's a cautionary tone as far as the client discussions are concerned. So TCS is down almost about 1%. In fact, TCS is now your top Nifty loser. So do keep an eye out on that. However, the rest of the IT pack is not doing too badly. So Wipro ahead of its numbers is up 1.5%. HCL Tech is up about 0.8%. And so is Infosys on the buyback news, up almost about 0.5%. Apart from that, you also have a lot of other names that are really bucking, or rather backing the market. Ultratech Cement is up about 0.2%. Adani Ports up 1.5%. Adani Enterprises, Asian Paints, Eicher Motors, Tata Motors, Tech Mahindra also in the green right now. But now the market is falling some more. The drag is, of course, coming in from TCS, but also HDFC, which is down about 0.6%. ICICI Bank, Reliance Industries are down about 0.5%. SBI Life is down about 1%, and so is Maruti Suzuki and Bajaj Auto, both the auto companies down about 0.5 to 1%. HDFC Bank is also dragging, and so is HUL. So all in all, you'd have to say it's not a great start. But in the context of, the global cues and the caution over there, the Nifty is still holding above the 200-day moving average and above 17,190 as well. The drag, though, is coming from TCS this morning. So do keep an eye out on that. Now TCS it's all over the place. Now it's actually moved into the green, and the dips over there are getting bought. So pretty volatile.
Well, I think, Sonia, it's all about positioning, right? TCS as well as the IT pack, yesterday towards the end of trade, it ended at the high point of the day. So that's why that initial dip, initial tick got sold into. And now, in fact, we're seeing some bit of stability with the IT index up close to around 0.5%. Infosys as well up close to around 0.5%. India Cements, well, yesterday towards the end of trade, you had massive delivery that you saw. And the stock ended virtually at the high point of the day in trade. Now the stock is down close to around 4% as a couple of brokerages, that's Motilal as well as Nuvoma, both of them highlighted that valuation-wise, well, the stock is still expensive according to them. So for the time being, it's down close to around 4%. But if the street believes that they're going to see more of the same and divestment of some assets, then maybe you'll see a bit of a recovery intraday. A couple of other names, Manisha Bio, remember there was positive news flow that came in there. So that stock is up close to around 18 to around 20%. Ashiana Housing as well, there was an operational update that came out there. That as well looked pretty impressive. So that stock is up close to around 8%. From the IT pack, Persistent Systems is up close to around 1.5%. And on the flip side, IDBI Bank, that did very well yesterday. Well, that one has given back some part of what it put on yesterday. So the Nifty, well, now we are stabilizing with a downtick of around 40 points. I'll tell you what, the bulls would have preferred a start in the red, get that intraday dip, and then make an entry point, because if it opened in the green, we saw that first tick getting sold into. Nifty Bank as well down close to around 100 points. But the mid-cap index, that's the one trading in the green. Higher number of stocks advancing in comparison to stocks that are declining. Prashant.
So, yeah, 50 points. And this is what I was saying. The pre-open was a bit bizarre. Slightly higher, even higher opening in the green. But that's kind of disappeared. And this is, of course, more like what we've seen yesterday and so many other sessions before it. Relative outperformance. But, the direction will be the same, but it's just that you fall less. So, 1/3% lower, 17,188. Is where we are. By the way, all the Nifty IT index constituents are in the green, all. So the top gainer is Wipro with a 1.25% gain. It's, of course, the most bombed out name. Expectations are that, it should be a good set from Wipro. Coforge is up 1%. L&T Technology Services up 1%. Emphasis is up 0.4%. There is Persistent, which is up about 0.25% as well. And TCS, I think, as Nigel mentioned, there's a lot to do with positioning. So it's kind of flipping between green and red at this point in time. So that's IT services. 2:1 is the advanced decline. You want to say something, Nigel? No. Sorry.
Just go on.
No. So the broader market, just a quick couple of more names. So HCC is coming up with a 3% gain. Now only highlighting things with volumes here. Schneider is up about 2.5%. West Coast Paper is up. Panacea Biotech, I don't know, 20% higher on Panacea Biotech at 160, 161. And it's got decent sized volume.
There was positive news flow, Prashant.
There's positive news flow there.
That came overnight, so that one as well is.
So that's the big mover on small volumes, but it's showing up on my volume list here. On the downside, of course, Nigel mentioned India Cements, and there is, I think, Aisha Motors and Ashok Leyland, which are down about 1.5% as well.
Just one more stock, Tilakanagar Industries, market capitalization of around 1,700 crores. There's a 3% large trade that took place. It will be interesting to see who are the parties to that. So we'll keep an eye out on that one as well. Stock mildly higher, but a large trade is what took place, close to around 50 crores of equity changing hands.
Okay, and on Panesha Biotech, I think, Ekta was telling us that there's a long-term supply that the company has got worth 1,040 crores, right, from UNICEF and from Pan American Health Organization. So this is for a supply of a vaccine. And I guess that 1,040 crore deal is resulting in a big 20% up move over there. Yeah.
I mean, the stock it's a huge move, and it's a completely bombed out chart on this one. The high was in May of 2021 at about 450. And the stock's at 160 now. So 160, and yesterday it was 140. So that one is the real big mover of the day. All right, now Vineet Sambre is our market master of the day. He's head of equities at DSP Investment Managers. Vineet, great to have you with us here. Thank you very much for your time. I mean, you fall, but fall less. So that relative outperformance is still very much here. And no real panic, right? Global markets are jumpy and panicky, but here, there is relative calm and that almost a feeling and assurance that things are going to be okay. We'll ride out of this not too badly, Vineet. Is that likely to play out in your opinion? How have things changed, your view changed since the last time we spoke?
Yeah, good morning, teams, CNBC-TV18, and thank you for having me on the show. So I think broadly, we've been watching the macroeconomic factors, which are currently slightly adverse as far as the global markets are concerned, and Indian markets, like you said, have been pretty resilient. When we look at the performance, even YTD, I would imagine that there is definitely in terms of our overall macroeconomic outlook, it seems that relatively we are on a better scale. If one takes a slightly longer term view. Most of the policies which we have been more favorable as far as the Indian economy is concerned. So from that perspective, I think some bit of outperformance is warranted. But given what is happening globally, and things are turning a bit more adverse at the margin right now. Again, crude has gone back up. The Russia-Ukraine concern seems to be aggravating. I mean, all those things definitely can create some more weaknesses, both at the global level and at the India level. But one thing this actually also makes us feel that this type of market, which is not a raging one-sided market, is a good market for the long-term investors. You need some consolidation. We've risen for the last 1.5 years, and since the pandemic. And the last 1 year, we've been consolidating. So I think that's a good phase. I would say some bit of consolidation weakness because of the global macros allows, the long-term investors to, work with more patience, look at good businesses, good companies, and invest with a long-term horizon. So I would say some bit of more consolidation, stroke weakness likely in the Indian markets given the global context, but the long-term view remains intact as far as India is concerned.
Okay, by the way, TCS is definitely seeing buying on dips. It's now moved to the high point, up about 0.5%. The low that TCS hit was 3,086, and now it's back above 3,130. So the dips are getting bought. What are your thoughts on the IT space? I mean, we've just got the first of the earnings, and it doesn't look too bad, Vineet, given the context of the macro challenging situation. Would you buy these stocks given that there is valuation comfort, or would you wait and watch?
Surely, Sonia, I think, what has happened in the last, the last year to date, we've seen good correction as far as the IT sector is concerned, and this is actually getting linked to the global technology correction as well. There is a lot of talks about recession and the impact of that. I think what is known today is that surely the global economies are going to slow, but what is sort of unknown is that what beyond that. I would imagine that technology spends are likely to continue. Maybe there could be slower growth, but the growth itself will remain. Good part is that because of this correction, the valuations have become more palatable, is what I would say. The next 6 months, when the noise around the recession slowdown is high, and let's say the stocks tend to consolidate or weaken more, I think that probably should be a good opportunity to keep accumulating and enhancing your weights across the IT sector is our view.
Hi, Vineet. Morning. Since IT is the big theme, I wanted to ask you, what about your preference out there? The large cap names or the mid cap IT companies? In the past, I think Cyient is a stock that you've liked. I think even eClerx is something that both those two are relatively cheaper in comparison to the pack. So what would your preference be from the IT space itself?
So I think overall, in terms of preference, I think there's a neutrality wherever we find value. Even within the large caps, we have chosen to be with names where we see the opportunity to be decent, and the valuations were relatively, not as expensive as the whole pack. But now the good point, as I mentioned, is that the whole pack, both the large caps and the mid caps are correcting, which is providing opportunity across the board, is what I would say.
Okay.
But one should not sort of very aggressively buy into the names right now. I think give it a good time period, do an SIP type of investment in these segments is, I believe.
Vineet, financials, what is the view? That is a one consensus overweight. Valuations are also below longer-term averages. As a sector, is that the top overweight for you?
Yes, absolutely. I think this has not changed since the last time also we spoke. Financials have remained pretty overweight for us. I mean, and I think given the macro recovery, which is holding up well as far as India is concerned, I would say the banking sector, which has cleaned up the balance sheet, they are ready to lend and grow, some bit of this rising interest rate also helps these banks in terms of their profitability as well. So I would imagine that when one looks at the profit table across the sector, the banking is the one which is going to add the most in terms of the profit growth over the next 1 or 2 years. And from that perspective, the overall stock valuations are also not on the higher side, is what I would say. So the banking pack also looks sort of pretty okay, and we are quite overweight as a house as well.
Okay, I just had a follow-up on the IT discussion. You said that the valuations have become more palatable in the IT space and you would accumulate IT through the SIP route. I guess that's the best way to do it, considering that, towards the year end we could be heading into a recession. But would you stick with the large cap IT names, or do you think the mid cap names? And under that umbrella as well, there are so many different kinds of stocks, right? There are the auto-related IT guys, whether it's KPIT Techs of the world, Tata Elxsi. Where would your preferences lie?
See, actually, we are looking at both the category, and I would say that mid caps have also corrected a lot more in the last few months, and which is where, like you said, there are specialized mid caps, is what I can say. Some of them focusing on auto, travel could be a good vertical, as it is opening up now. Similarly, there are niches which some of these companies have carved and ventured into, engineering skills and all of those. So I think these are something which basically gives them a good, let's say, moat over the next few years, and also the opportunity to grow. And the valuations, as I said, are okay. So I think it should be a combination of both some large cap names. The mid caps, where I can say that they are catering to specialized category, those can also be looked at, given the valuations are getting on the reasonable side.
Okay, all right. Vineet, what about the healthcare space? Do you believe that's going to be a sector that you like to buy, maybe on dips? The pharma index, in fact, hasn't done much in the past many years. So how do you approach this space? Will it be the diagnostic companies? Will it be pharma? Or do you believe there is still more pain before you get in?
So I think our focus has been on the pharmaceutical companies at the moment, because those are the ones which have been lagging. And to me, it is more of a price performance, and the absolute performance. Maybe there is some bit of pressure right now, but I think these are beautiful companies generating good amount of cash, distributing dividend to the shareholders, and working with a very decent capital efficiency when one looks at their ROC and ROEs. Just that in the cycle, I think the businesses today are facing some challenges in terms of the higher raw material price and all of that. Those, I think, in the next 1 year or so, we'll see a very different scenario where some of these inflationary pressures would surely recede, and also the US markets, which have been a bit slower, should also start providing them opportunity. And good part is that all of this is not baked into the valuations today. There is a good amount of optionality which can get created when we look at the sector at the current level. So I think we are pretty positive on the healthcare sector. And as I said, for IT, I think for healthcare also it makes a lot of sense to keep accumulating the stocks here.
Okay, Vineet, we'll leave it at that. Thanks a lot for joining in and a very helpful discussion on all the sectors in focus as well as the IT space. He says IT valuations are becoming more palatable now, but would buy IT stocks in the SIP format because we are heading into a recession. So every dip should be used as a buying opportunity, but don't buy in one shot because you could get better levels. Let's shift gears now to the real estate space. By the way, in that context, Soba's Q2 update has come through. The new sales are actually fallen both year on year and quarter on quarter. So that's interesting. 13.3 lakh units. The sales value though has gone up and realizations are looking very good. But in the context of more floods in Bangalore and all that's happened in the recent past, the question is whether these realizations and prices will hold. We have an entire discussion lined up. Knight Frank released their report for Q3. And they said that housing units sold have come in at a decadal high of almost 74,000. There's been a 35% year-over-year growth in Mumbai and a 21% rise in the units sold in the NCR region, even as interest rates continue to move higher. We are joined by Ghulam Zia, the Senior Executive Director at Knight Frank, and Pavitra Shankar, the Executive Director at Brigade Enterprises. Lady and gentlemen, thanks a lot for joining us. Pavitra, I want to start with you. The Mumbai market, as Knight Frank put out their report, very strong sales coming through. Is that a market that would interest you? A lot of your peers have gotten into it as well.
Hi, morning everyone. Currently, our focus is actually on Bangalore, Chennai, and Hyderabad. Mumbai, we know, is a great market. Again, it gets a lot of visibility. NCR as well. But for us, I think our focus currently is on the southern markets. This is the market that we know. They all have very good similarities with each other in terms of your target demographic, in terms of buying, preferences shown by customers, in terms of the IT economy as a driver. So we're confident with these markets that this is what will drive our growth for the next few years and for the near to medium term. So currently, no, we are not looking at Mumbai.
All right. Hi, Pavitra. Morning. In the past, I think you've said that IT, ES, bulk of your, or a large segment of your sales come in from that particular division. So good to see that the TCS management as well sounded rather optimistic. My question to you is that, RBI's hike rates by around, 190, 200 basis points in this year so far. What kind of impact has it had on demand? And if you could give us a couple of numbers of your total sales, how much is affordable? And out of that, maybe out of your total sales, if you could give us a sense about how many of those buyers take loans to buy flats. Go ahead.
Yeah, so in terms of our overall portfolio, affordable is what I would categorize as the government definition of below 45 lakhs and 60 square meters, at least in urban areas. A very small percentage, I'd say less than 5% of what we're selling today actually belongs in the affordable housing category. It's not really seen as much demand, I would say, from like a larger developer where it's really the size of the units that is making it affordable rather than, the location of the place or the kind of amenities or specifications of the product. Those are typically like a regular product. So almost 90% of our portfolio is mid-segment housing, and that's where we've seen to be the major driver of growth for us. In this segment, as well as affordable, we see at least 50 to 60% of our buyers take home loans. I would have actually expected that number to be more even when home loan rates were lower. But across our portfolio, we see it as being only around 50 to 60%. And this is despite many of our buyers being white-collar salaried workers. So the increase in interest rates, it is something to watch. So far, we have not seen any impact, but that's mostly because of the kind of product that buyers are looking for today. They're looking for larger, larger units, 3 bedrooms, 4 bedrooms, and so on. And ever since the pandemic, this has been the type of inventory that is extremely high in demand and also very low in supply today. So when a potential buyer comes across the kind of inventory that they're looking for, the increase that we've seen in interest rates is not going to hold them back.
Ghulam, coming on this discussion, do you also believe that companies like Brigade, a lot of the premium guys, whether it's a Prestige, a Lodha, they really won't be impacted because of the rising interest rates? I mean, you spoke about almost 74,000 housing units sold in Q3, which is a decadal high. Is this a sustainable level, or do you think demand could get hit because of rising rates?
Since we're only talking about home loan interest rates, I would keep it to just that one factor, because there are multiple factors that affect the sales and performance of these players that you're talking about. Only home loan interest rate, I'll just give you one interesting number. Somewhere in 2010 or 11, I believe, the previous best performance in Indian residential sales was attained. And that time, the home loan interest rate is almost touching 10%. Okay, so today we are still at least 200 bips away from that. So there is no reason for us to believe that at least in these markets, which are the top 6-7 markets, in the next couple of years, at least we're not too concerned about home loan interest rate alone making that impact. Of course, affordability is the key. And right now, the affordabilities are well in place, while nominal price rise has been observed in last couple of quarters, but that still is not disturbing the apple cart yet. So the point remains that, some little 50, 100, 150 bips increase in home loan interest rate is not going to have so much of an impact on the sales of residential units.
Ghulam, although we are already at 9.5%, by the way. One
Well,
doesn't realize that slowly it's creeped up on us.
Not really. The transmissions are not entirely, like whatever you're talking about, 190 bips of increase that we have seen from the lowest, has not been completely transmitted. So I'm still talking about some time to go. Where we stand, even the SBI is not even touching 8.5%. It is below 8.5%. So that's where it is. The transmission is also the key.
No, then maybe I need to talk to my banker because I'm at over 9%. I'm telling you from personal experience.
You're getting conned.
I wouldn't go that far, but yeah, it's... and I know, friends and colleagues, etc. So you're right. Maybe the full thing has not been passed in, which means that even from here, there is more to come. And you're saying there is no impact, Ghulam?
Not really. We would have loved to watch that, but we've been very closely monitoring the numbers. And quarter after quarter, in spite of at least 3 or 4 huge jumps that have come into home loan rates, in spite of that, the transaction numbers haven't really shrunk so far. And of course, it was... the Diwali period is also oncoming. So all this has really had an impact. We have good sales that we've been observing, but year-to-date sales have been best in last 10 years. We are almost about going back to the numbers that we saw somewhere in 10, 11. So that's what is giving me some comfort that the buyers are still fine with the home loan interest increase that is coming their way. We'll have to obviously wait and watch for another 1 or 2 rises. How is the impact on the market? But so far we have been observing not much of an impact. It's only going up.
No, that's good to hear. Pavitra, I think I've asked you this before as well. For the lack of a better way to describe it, right? The pent up, it's almost, COVID was a shock to the system, right? It's maybe 10 years, 15 years out, we'll be able to finally kind of figure out what it did mentally to people as well. Because it really jolted the real estate sales higher. People, were looking out, they wanted bigger flats, premium properties, etc., etc. So that push, is that what is still continuing? It was also a big dislocation, right? You saved, you could not spend for a while, so you were sitting on savings, and now that is getting released. So what's the runway? How do you think about that in terms of the momentum continuing?
Yeah, I would say the main thing that changed after COVID is a massive reevaluation of everything in life. And that sort of came to hit home quite literally, even in the way people were using their living spaces. So whether they were renting, whether they were in a 2-bedroom wanting to upgrade, everybody was sitting there, in their houses, sort of relooking at what they actually needed. And maybe some
companies, but the lone bright spot will be that cement demand has been reasonably supportive. Now, the street expects around 8 to around 10% year-on-year demand growth for the past quarter. Fallen commodity prices like steel, that helped demand recovery from the infrastructure sector during the quarter. That should further accelerate in the second half of this year. Now, Kotak expects 11% year-on-year growth in terms of volumes, which will be led by Shree Cement, Nuvoco, Dalmia, Ramco, as well as Ambuja Cements. They're all up for you on the screen. The problem was that cement prices were weak, as prices corrected by roughly around 4% on a quarter-on-quarter basis. Though it was monsoon season, this correction in terms of pricing was sharper than what we have seen in prior monsoon periods. The other reasons for pricing weakness is due to the rollback of the earlier hikes, as the government focus turned to curbing inflation after the price hikes were taken in April 2022. North, well, we saw the sharpest decline out there. There was a price correction to the tune of around 7 to around 8% on a sequential basis. However, the quarter ended on a positive note as we saw some price increases towards the end of the quarter, particularly in the eastern part of the country. And higher input cost, well, that will result in a sharp knock on margin. So two factors playing out, lower prices as well as higher input costs. Jefferies estimates that the industry unitary EBITDA will fall by around 350 rupees per ton sequentially in the past quarter. And from the top names, well, majority of the top line will be led by higher volumes, while the remainder will come in from higher prices. What stands out is the sharp contraction in margins that will be seen in all companies in the past quarter. This as the high-cost raw material inventory will gradually get utilized. The second quarter FY23 is expected to be weak, so the street is bracing for it. But the hope is that quarter 3 FY23 EBITDA will improve big time as pet coke prices, which constitute bulk of the fuel mix, well, that's corrected by around 20 to around 30% from its peak. Though thermal coal prices, well, they continue to remain elevated. Now, since it's post-monsoon, cement price hikes as well are likely to begin to take shape. Additionally, the street hopes that construction activity picks up. That will keep the off-take momentum going as well. Another benefit for the coming quarter will be that there is unlikely to be a volume push by ACC and Ambuja this time around. Remember, their closing for the year has been changed. Normally, it is in December. It's moved to March this after Adani took control. Finally, we leave you with a valuation chart of all the companies on an EV upon EBITDA basis. Back to you.
Okay, thanks a lot for that. Very helpful and thorough check on what to expect this time from the cement space. Rajesh Ravi, the institutional research analyst of the cement sector at HDFC Securities, joins us now. Rajesh, thanks a lot for joining in. You heard out what Nigel had to compile in terms of the cement sector. You tell us, what are the big things to watch this time around and which are the stocks on your radar?
Yeah, hi, good morning, Sonia. Yeah, I heard out Nigel and I think he has compiled it quite well. This quarter is good in terms of demand. We are expecting around 8% volume growth year on year. Sequential just 8% decline, which is relatively better than a normal monsoon quarter, witnessing more than 10% volume contraction. So yes, volume numbers have been better. And even on pricing front, it's the earlier base whereby, in a monsoon quarter, usually we don't see any price hike to be affected for sure. The price corrections we are looking at is close to 3% Q on Q, which is again, a decent number rather than extremely pessimistic number, given the pressure most of the areas witnessed heavy rains. The key concern has been the fuel prices, which continue to go up till mid-quarter, and thereafter petcoke prices have seen significant cool-off. Even Indonesian coal prices have come off. However, the benefit of these will only be seen Q3 onwards. So Q2 numbers for the sector as a whole, we are expecting fuel prices to be elevated by 100 to 200 rupees per ton, and with lower realization, and also because the utilization will be lower quarter on quarter, there will be further pressure on the cost sequentially. So this quarter is supposedly the worst quarter the industry is staring at. Most of the from 5 to 6 quarters back reporting the peak margins, and they are now coming down to sub 700 rupees per ton on an industry level. This is for sure one of the worst quarters the industry has seen in last many years. But as I said, with fuel prices now looking, have softened, and while there is some spurt again from the lows, if things remain stable, I believe Q3 and Q4 onwards, the industry will see margin expansion. As Nigel also rightly pointed out, the companies have rolled out price hikes, and in part, most of them are getting affected. So they will push up the margins in subsequent quarters.
Rajesh, just one second. I mean, the market, look at the market, is taken a dive. 90 points gone now on the index at 17,150. So this is at the day's low, easy at the day's low. And I think the big thing which has happened, if you can have the Nifty intraday, the big change which has happened is that the IT index has completely given up all its gains. There you go, 95 down now, almost approaching the 3-digit cut mark. And the IT index has given up all its gains. Although, if you look at constituents, only 2 Nifty IT stocks are in the red. what's happened is everything else. I mean, Infosys, for example, the day's high was almost 1480. It's come down to about 1464. So gains have been given up, although stocks are still not turning into the red completely, except TCS and Tech Mahindra, which are down. TCS is down almost a full 1%. So that's the big change which has happened. Just wanted to point that out. 98, 99, so sort of dropping as we speak. Nigel.
Okay, all right. Well, that's about the index. But, Rajesh, I wanted to ask you about this deal that took place yesterday, India Cements. Finally, after many, many years, I think the street has been waiting for them to do something on the debt front. And this is sort of a first of its kind announcement from the company. But they wanted more, looks like, because that 600 crores that they're going to get, it seems it's not enough. What's your view on the stock? And if you could give us a rough value, that 1.5 million ton, now our sister concern, CNBC said that they could be looking at selling that Rajasthan unit. What would be a fair valuation according to you?
So first on this deal, see, this is a good move because one of the things which the street was looking forward from India Cement was to reduce the borrowings, which is hovering north of 3,000 crore for quite long time. And given that the management have always been talking that they have a lot of non-core assets which could be hived off to reduce balance sheet, so hopefully more of them should follow. So that will obviously have a positive bearing because operationally the company is quite constrained, even though it has premium brand positioning in the southern markets. But on the cost front, this is already heavily stressed. So in that scenario, a high balance sheet is also not a very great thing India Cements is looking at. Now coming to the North Unit 3, Netra Cement, which they had amalgamated a few years back. This is from an India Cement perspective. Obviously, it doesn't hold much synergies. That 1.52 million ton company capacity. Now, while I don't have the intricate details in terms of the limestone capacities and the operational efficiencies metrics, but fair to say, even if it's a relatively older plant, most of the such acquisitions may happen between 600 to 800 crore per ton. Ideally, that is the valuation we should be looking at. So if it is a 1.5 million ton, another 1,000 crore could be garnered by the company. So if at all that goes through, that will significantly improve the balance sheet for India Cements.
Okay, all right. So that'll be interesting. The other unit that everyone's been talking about is the JP Group unit. I was going through the annual report and they have 10.5 million tons of capacity. What should be the rough valuation out there? Out here, you have told us close for 1 million tons, 600 crores. For that unit, some of them have a backward integrated clinker. Some of them don't have. It's only grinding. So for this 10.5 million tons and around 350 megawatts of power, what should the valuation be?
So, see, as per my understanding, the clinker capacity for there are two units of clinker, and between them there are close to 4.5 to 5 million ton of clinker, or maybe 4 to 5 million ton of clinker is what my assessment is. So 4.5 million ton of clinker, and so approximately you can say that 7-8 million ton in integrated plant. Assuming these capacities are well integrated, are quite operational and in good shape because the company has been under pressure, working capital and production has been under stress for past 3-4 years. So it should get a valuation of 800 crore per million ton. At least this 5,000 crore or number 5,000 to 6,000 crore is a fair value because whoever acquires it will also have to do a lot of maintenance capex and get things up and running.
All right, we'll leave it at that. Thanks a lot for joining in. Well, the market's still under pressure, actually. It's holding on to the 17,160 level, but it's getting worse in the broader markets as well. The mid-cap index is now down about 100 points. The Bank Nifty is down almost 200 points. And plenty of stocks, Eicher Motors, ONGC, Apollo Hospitals, JSW Steel are all seeing big cuts, anywhere between 1 to 2%. Good time, actually, to get our technical expert in. Mitesh Thakkar will be joining in for some technical trades. Do stay tuned in.